Welcome to this Killick Explains Finance video. This week, what should investors read into the latest activity in share buybacks? Now, what have people been saying? Well, I've picked one quote here. Bloomberg have picked up the idea that in the US, buybacks have fallen the most since 2009. So let's take a quick look at what buybacks are, why they've been really popular in recent years, and what might explain the sudden reluctance of firms to do them at the level they have been. Now, the basics. First of all, if you've got surplus cash as a firm, what can you do with it? Well, there are several options. You could keep it as a kind of safety blanket. You could invest it and expand the company. You could pay a dividend, increase the existing dividend, or even pay a special dividend. Or, and this has been popular in recent years, you could buy back your own shares from shareholders. So use surplus cash to decrease your capital base, in effect. And that's certainly been a popular route, both in the US and in the UK. Companies buying back their own shares have been one of the bigger buyers of shares in the stock market. Now, why do firms do this? Well, there are lots of reasons, some good, some bad, if you like. The marketing spin would usually be something like, well, actually, if the share price has been unduly punished, buying cheap shares adds value for shareholders. Returning capital that we don't need, that we haven't got an economic and productive use for, is good corporate strategy. Cynics would say yes, but actually buybacks also boost key ratios. More about that in a moment. They maintain the value of stock options, which if you're an executive rewarded with stock options can be useful, and they can ward off predators by decreasing the capital base of the company. So those are slightly more cynical reasons, you might say. Now let's take a look at that boosting key ratios. That's certainly true. So if you buy back your own shares, you boost two in particular: return on assets, because by buying back shares, which is a capital transaction if you like, overall profits are unaffected and you've decreased your asset base. So the return is now on a smaller asset base. Bingo, return on assets boosted. The other one that gets a boost is earnings per share potentially. Similar logic, earnings are actually not affected by a tactical decision to buy back your own shares, but the number of shares in issue decreases. So same earnings over a smaller base, earnings per share boosted too. So you can see the attraction here. In other words, what I'm saying is no increase in operational performance, but with this buyback, better return on assets, better earnings per share. So that begs the question, why are firms suddenly putting the brakes on? And they are a little bit, especially in the US. Here are a couple of stats. Announced repurchases dropped 38% in the last 4 months. And that's where Bloomberg picked up its biggest drop since 2009 headline from. And they historically have been 80% executed. They're quite a good lead indicator as to what might happen in the future. And planned buybacks amongst US firms have tumbled from a year ago. So suddenly we've got a big drop, all right, and you can see that the amount by which buybacks have been reduced in the US is 2.5 times the annual decrease in profits for S&P 500 firms to the 31st of March. So quite a lot of evidence that firms have pulled up the drawbridge a little bit. Now, why is the key question? No one knows for sure. As an investor, I would keep an eye on this one. So an optimist might say something like, well, this could be managers simply reacting to criticism and acting more responsibly. There are people like me who've criticised share buybacks. Maybe managers are kind of getting the message, if you like, and maybe firms are just pausing, all right, and will resume buybacks later in the year. So maybe this is just a pause, a little bit of uncertainty in the market, and business as usual will carry on, whether or not you like share buybacks as a mechanism. However, pessimists, if you like, or cynics might say, actually, is this evidence that in the past companies have been too generous and are suddenly reining back, thinking, oh crikey, actually we do need to protect our balance sheets now? And could it be a bit of nervousness creeping into markets and managers thinking, actually, now is not the time to be committing cash to buyback programs? Now, I wouldn't like to call it either way. It's one worth keeping an eye on. We'll find out later in the year whether the pace of buybacks picks up again, whether you like them or not, but they're indicative, potentially, of the way firms are thinking at the moment. Any questions? Quite a big topic. editor@killick.com. And if you want to see videos on a range of related topics, please do go to our video library, killickexplains.com.